Hello and welcome to the 2026 Midwest Multifamily Forecast brought to you by Gray Capital. My name is Griffin Haddad, co-host of the Gray Report, as well as the manager of investor communications here at Gray Capital. We're excited to break down our most recent report, the 2026 Midwest Multifamily Forecast, with you. And bringing with me today, I have Spencer Gray, host of the Gray Report podcast, as well as the CEO and principal of Gray Capital. We also brought along John Chapman, data scientist here at Gray Capital, to break down his methodology and the numbers in more depth than Spencer and I can provide. We're excited that you've joined us. Hopefully you've read the report, but because you're here with us today, we're going to take you beyond the data, deeper into the markets with insights and other pivotal aspects of these markets that you otherwise wouldn't get in the report. Spencer, you excited to be here?
Griffin, I appreciate you bringing us in. I'm very excited to be here, excited to kind of go over the details of this report. And you, John, the team have been working on this for months, really, quite some time. And so it's putting together a lot of work for this past year. 2025 was a dynamic year, to say the least. 2026, I think, is not going to give us the absolute clarity as like some folks would want to, but I think having a little better insight and some clarity of that not everything's perfect. It's not like we're over the hump of some of the challenges that we experienced in 2025, and really since we've been experiencing since 2023. But it gives us an insight to some normalization and some where there may be some greener shoots in the latter half of 2026 into 2027. But very excited to be here.
Right.
Thanks, Griffin.
We've had today circled on our calendar for quite some time just to be able to share these insights, discuss the data with John. John, this is the first time you've seen your report printed in physical form. That's got to be an exciting moment for you as a co-author. How does that feel?
Oh, absolutely. It's great to have it, on paper, get something out to everybody. A lot of good work being put into this, especially on your end, Griffin, and it's great to get to go over this in more depth.
Absolutely. Now, before we jump in, I think it would only be appropriate for us to give a brief background on Gray Capital, just as there might be people that are watching that are not specifically familiar with our firm and our investment strategies. Spencer, would you like to do that?
Absolutely. Gray Capital, we're a vertically integrated multifamily owner and operator. It's really a private equity real estate company. When I say vertically integrated, that means we do our own property management in-house. We do a lot of our own construction management in-house. And we also, we put out a lot of great content. These research reports are part of that content. And just an example of the type of work we do, it's not just aggregating information elsewhere, although we do a ton of that also. But this report really has bespoke and novel information and analysis. Then we have the Gray Report newsletter that comes out every single week, every Thursday at 8:30. We've been doing that since 2020. It's one of the best real estate newsletters that's on the market. Covers multifamily, commercial real estate, macroeconomy. As you know, Griffin, we do the Gray Report newsletter or podcast and YouTube show once a week as well. You co-host that. It's a great time talking about a lot of those research reports, articles, just what's going on in the multifamily industry. And so highly recommend, if you're not subscribed to the Gray Capital YouTube channel, which is the home of the Gray Report, go ahead and subscribe now, press the bell icon so you can be notified every single time we have a new piece of content. We love doing kind of events like this also to take a deeper dive into some of that research. Gray Capital, we've had a history of being a firm for over 10 years. We've done over $2 billion of transactions since we've started. The total portfolio, including our core portfolio, our co-GP portfolio, is around 7,500 units. And we operate in the Midwest. So we're based out of Indianapolis, but we target markets in Ohio, Kentucky, Michigan. And so, this report, at first, it's for internal use. We want to be very knowledgeable about the markets that we know, but we want to have a deeper understanding of. But it's a great opportunity to share that internal research with the broader investment community and our partners as well. Got a lot of active projects. We try to do a lot of good work. And this is an example. There's some pictures of the types of assets we own. A couple of our properties, Villas on Fur, Flats at Stones Crossing, and Sycamore Terrace, just to give a little bit of an example of the type of work that we do here at Gray Capital. And again, make sure you check out the Gray Report right here on YouTube, but also make sure you're signed up for the Gray Report newsletter as well. You can do that at graycapitalllc.com. Well, Griffin, you want to just give us a little bit of a preview of kind of what folks are going to be experiencing
Right.
On today's show?
2025, it's in the rearview mirror. The only thing that we can do is continue to look forward into the next year. And so when we put this idea together of the 2026 multifamily forecast, specifically in the Midwest, as an operator in the Midwest, we obviously have target markets that we were most intrigued by, most interested in. So our report not only covers the national rent trends projected into 2026, but we also are including forecasts for rent growth, starts, and vacancies across several of our target markets here at Great Capital. Specifically, will be markets such as Chicago, Lansing, Indianapolis, Louisville, Cincinnati, and Columbus, Ohio. These markets are all within our zone of operational excellence and are all markets in where we're looking to acquire Midwest multifamily assets. The report not only covers the 2026 forward-looking projections, but it also incorporates what I would like to think as some future forecast into 27 and 28 in regards to projecting 26 starts, which I think is quite interesting. John, we'll get into that a little bit later. The other thing that I also am excited to hear more about today and what we're going to cover in this section is the methodology of how this data was derived, how we made our forecast for 2026. And John, I'm looking forward to hearing that from you. And then if you're watching on our live stream today, please bring your questions in the chat. We are monitoring that. If you do have a question, it's likely that we'll see it. If we can get to it right away, we absolutely will. In the event that it does take us a moment, please stick around because we will address all questions at the end of this live stream and forecast. So let's jump right in. We've got 5 takeaways that I'd love to ask you about, Spencer, from the report, kind of a high-level summary of what we're seeing. The first takeaway being that the Midwest is going to sustain its rent growth leadership across the national average. What does that mean to you, and what does that mean to Great Capital moving forward?
Yeah, I think the key part of that main point is we're talking about sustained rent growth and compounding rent growth, where there are some markets that are now like the rent growth leaders. It doesn't really matter, who's necessarily the top of the leaderboard, 1 month, 1 quarter, even 1 year. What we're talking about, or really highlighting, is some of the sustained growth that the Midwest has seen. It's really embodied that steady Eddie moniker, but not being as slow and steady and sleepy as I think some investors perceive the Midwest being. We all know that the Midwest is considered to be kind of like flyover country. You're focused on the coast and maybe the Sun Belt, Texas and Florida, and it's easy to forget about the Midwest. But some of that growth has been creeping up on a lot of folks. So it's really the focus on the sustained rent growth, because what we'll see here throughout most of these markets is we're not talking about a ton of rent growth. In fact, we're talking about the lowest rent growth that we may have seen in years. But in the context of multiple years of strong rent growth, I think it's important to understand that when we might compare it to other markets in the nation for right now, like San Francisco, which is seeing incredible amount of rent growth, but their actual nominal rent levels are still below where they may have been back in 2019, where these Midwestern markets have been compounding year after year.
Right. And you just voiced it. It's slower growth that we're forecasting. Talk to me about the second takeaway here. The slow growth equals better entry points.
Yeah, this is a little counterintuitive because I'm getting ready to tell everybody that, hey, look, like next year doesn't look that good. And so you might assume maybe this isn't the time to invest in these markets, or maybe it's not the right time to invest at all. That is only the case if you have a very short investment horizon. If you're looking to make an investment and have that go full cycle in the next 12 to 18, even 24 months, I would even say even 36 months, best to stay away. There's probably a different asset class that you can participate in. If you're looking at a longer term investment profile or a horizon, 5-10 years, this starts to look like an interesting setup, because when I go to acquire an asset and I'm underwriting that property, I'm making assumptions on rates of growth. And as I increase my rates of growth, so I'm going to get, whether it's 1, 2, or 5% rent growth in subsequent years, that affects what my total return is going to be. Obviously, if I have really high rent growth over a whole period, the returns are going to be higher than lower rent growth, right? Mm-hmm. And the higher return will allow me to pay a little bit more for that asset. Because a lot of investors are solving for some sort of return metric, whether that's total return that's expressed in internal rate of return, IRR, or a multiple of invested capital, or maybe it's cash on cash return. And most investors, they're solving for that return metric. So if the growth assumptions are subdued, the returns are going to be lower, which doesn't allow buyers to overpay for an asset. The amount, the aggressiveness that they're allowed to get is lowered because they have to bake in lower growth assumptions earlier on. So our point is that there could be some interesting entry points in these Midwestern markets in 2026 because other buyers can't forecast a lot of growth. And some buyers, for the reasons we were just mentioning, may still remain on the sidelines waiting for absolute clarity to occur. Just let me give you a quick tip. There's no absolute clarity. Right. And you have to get outsized returns, you have to get in earlier. You want to buy the rumor, sell the news. You don't want to read the news and then make your decision. That news being higher rent growth, well, you might have to wait until 2027 to get that story. But at that point, cap rates will most likely be further compressed. And it might be too late to get the really attractive basis entry points that a lot of investors are truly looking for.
Right. Makes a lot of sense. And this report specifically will just be the kind of tip of the iceberg in regards to that growth that will occur over the next few years. As you'll see, a lot of our growth is suppressed or just not at the momentum at which it was a few years back. Talking about better entry points, distress, it's a buzzword that's been around for
too long.
As long as I can remember. Let's talk about the distress in 2026 and how it might spur some deal flow. What types of distress are you expecting to see in 2026?
Now, the Midwest has experienced much less distress than other parts of the country. If you go down to Texas or other parts in the Sun Belt, you're going to see more examples of kind of short-term value-add deals that went belly up. Mm-hmm. Most likely because they bought at record low cap rates, they put short-term floating rate debt, and the values of those assets now have reduced significantly. Maybe it's worth the value of the debt. Maybe it's worth even less. And those value add plans maybe didn't work out that well. There's a lot of deals that are just suffering, especially if you're in a region like the Sun Belt that has experienced negative rent growth over the last several years. Again, comparing back to the Midwest, markets like Columbus or Indianapolis, or even a market like Chicago has seen positive rent growth year after year. And so while we still have the problems of, higher, expense burden and, interest rates are certainly higher than they were. So if you were on a floating rate loan, you're still dealing with that higher interest expense, but you don't have a revenue problem to compound that issue. And so being able to maintain positive rent growth has helped the Midwest. That being said, some deals are still going to be troubled. And this is more of a national comment, but the Midwest not to be excluded. Going to just take a look at this chart quickly, looking at multifamily loan maturities. These are just CMBS loans. This is not the entire market, but it's representative of when transaction activity took place. We've highlighted this red region as a period of higher degree of stress. It doesn't mean that we're going to see a dramatic increase of foreclosures. Generally, the banking system, lenders have managed this crisis by extending and pretending and smoothing out the curve of distress, allowing borrowers to take kind of another shot at right-sizing the property. The problem is the time has just gone on too long. It's been year after year of extending and pretending. A lot of these assets have been able to be refinanced through a cash-in capital call into the asset itself, giving that property another couple of years of a chance to turn itself around. But as the data indicates, we are going to see just a lot of loan maturities, which are inflection points of where property needs to be refinanced, it needs to be sold, or some sort of capital activity needs to take place. Many of these problems that we're seeing are being solved either through a refinance with internal capital calls, but it gets to a point of where a lender says, look, we've given you enough shots, given you the chances. It's time to sell this asset. Your time is up. And so it's an opportunity, or it's a time where we could see more of these distressed opportunities emerge. But you want to be careful because, one, there's a risk of catching a falling knife. But also, make sure that what you're buying truly has value. Just because you're buying something for 80 cents on the dollar, make sure it's not actually worth 70 cents on the dollar, 60 cents on the dollar. So you have to be a skilled operator to take over these properties. You have to go in, fix them up, stabilize them. There's also those opportunities on the development side, newer assets that were built, great market, great product, but the debt's just too much. The values aren't correct with the current market. Could be some additional opportunities to acquire newly developed assets from maybe not distressed developers, but call them stressed developers.
Seems like 2026 could be a great year to be making acquisitions. The fourth takeaway and really the fifth takeaway, we can group those together. We're dealing with what people are calling a supply cliff. You'll see in our report, starts are kind of elevating. And so we're not really going to see this massive cessation of supply. There is a decrease, and it's more of this kind of valley in what we're expecting in regards to overall deliveries of multifamily units and assets. How does this sharp supply drop that we've seen in the back half of 25, how is that impacting overall this regional advantage that the Midwest has in regards to the rest of the nation?
Again, we may not feel it as much because the Midwest has been more balanced compared to other regions. But that being said, there's still a 40-year peak in deliveries in the Midwest, just like it has been through the rest of the country. Just the extreme hasn't been as much in the Midwest compared to the Sun Belt. Right. Markets in the Midwest have been delivering, new inventory as a percentage of existing inventory, kind of in the 6 to 8% range. Where in the Sun Belt, you had some markets as high as 14%, like Huntsville, for example. So we don't have the extreme difference between absolute peak supply to, dropping off. Then we're coming back to normalization. But we're still seeing about a 60 to 70% difference in deliveries in 2026 than we've experienced in 2025, which is very healthy. Key piece to note, though, depending on which market you're looking at, we're starting to see starts pick up, and our forecast indicates that 2026 will see a rebound in starts across many markets, not all markets. And so that appears to be more of a track to normalization, which is good and a healthy sign that there is demand from the lender side, from renters. It's certainly what we need in this country because we have a housing shortage. But it's not that panacea that some investors were hoping for, in which there'd be absolutely no supply coming online over the next 5 years when all the developers have just stopped building. That's not the case. Financing was challenging, but shovels are being put into the dirt, or at least they're being planned to for 2026.
Right. The last takeaway, we've seen in the past 2 years, 12 months, a slowdown in rent growth, a decelerated rent growth, but we've also seen maybe unsustainable expense growth. And we've talked about this in the past. The math just doesn't math if you continue these expense growth rates alongside this, deceleration of rent growth.
Yeah.
Looking at the fifth takeaway, fundamental strengthen as cost ease. I'm excited to hear what you have to say about this.
Yeah, this was not a piece that was derived from our research and our forecasting. This is more of an observation, having conversations with so many different operators and owners and seeing what's going on in the market. But it's and also looking at some of the anecdotes from our own portfolio. As you said, a lot of expense growth over the last couple of years, very much unsustainable. I think the public, when they look at rents, the way that they increased back in 2022, they'll look around and say, look at all these greedy landlords. But when we look back in 2025 or into 2026, and we see that expenses have actually outpaced that rent growth. And there are many properties that have really negative margins over the last few years. And truly to be able to continue to maintain these properties, rents actually need to rise a little bit more than they have. But we're starting to see some relief. It started this year, and I think we're going to realize some of that expense relief into 2026. One of the biggest stories is insurance premiums are coming down. We're getting big savings across our portfolio. We're seeing that across the industry right now. I think the insurance industry overcorrected a little bit. And of course, in the Midwest, we're all looking around saying, I don't know when the hurricane in the Midwest is going to hit us, but it seems like we're paying for all of you, the coastal buyers. I get it, spreading the risk pool around, but we're seeing some savings from insurance. A lot of just AI-driven efficiencies, automation efficiencies. A lot of this is, again, we're just being forced to find ways to save money, do more with less. And I think 2026 will be the realization of some of those efforts. Successful, and that also includes, some centralization efforts. Like we're doing that at Gray Residential, Gray Capital's property management company, where we're centralizing a lot of our staff, doing more from the corporate office, having the on-site teams focus on what needs to be done on site, which is, resident retention, resident care, customer service, touring new prospective residents. We don't necessarily need our on-site teams to be doing bookkeeping or administrative work that we could be doing at the corporate office in a much more efficient way. Then also, we've also had some successful tax appeals. And so we had property taxes, at least in Indiana, really increase over the last year. We were able to successfully appeal some of those. We see that trend occurring across the country as well. Where this all comes down to is even without like very strong rent growth, we may see some NOI growth just from expenses normalizing a little bit to start growing that net operating income a little bit, which at the end of the day is more important than just the revenue growth.
Yeah. So it seems like the 5 takeaways really can be spread across acquisitions as well as the existing portfolio and the management of those assets. Altogether, 26 seemingly appears to be what is going to be an exciting year for the multifamily industry, as well as Gray Capital as we continue our acquisition strategies across the Midwest. Let's take the pressure off of Spencer here really quickly. I want to focus on you, John. I want to talk about the methodology and the data collection to not only produce this report, but to also take a crystal ball approach to 2026, formulating some of the forecasts that we have across starts, vacancies, as well as rent growth. Talk to me about how you got to this point to where we could put the numbers on paper, PDF it, and send it out to the masses.
Of course, yeah. So we started initially with just looking at starts and permits and finding a good relationship between the two. Something we did that has not been done commonly is we actually used a predictive ratio between permits and starts to have a better pulse on what percent of permits we believe will turn into starts later down the line. Additionally, we collected several macroeconomic indicators across the board that we could apply to different markets that we focused on. These would be like inflation numbers. Other examples would be like consumer price index, employment opportunities, and really just different things, different macroeconomic variables that affect the markets no matter where you're at, and looking at how those variables play into each individual market on a specific level. Once we collected all that data, we then added in historic rent growth data, as well as construction and permit data, to establish good connections between all of the variables using some different statistical techniques. We tested, of course, to make sure that all the data was valid, that it could all be used inside the model, reshaping it as needed with transformations, different statistical methods to ensure as much authenticity and validity mathematically as possible. Really just making sure with good rigor that what we were producing is as honest a forecast as possible. Once doing that, we created a machine learning model that comprised an ensemble of a few different machine learning methods and used information criterions to determine what the best parameters were to tune those models to. And then we used cross-validation to ensure that the models being produced were as honest as possible and accurate as possible.
A lot of big words there. But what is like some of the differences in the approach that you took that maybe others have taken in the past? What's the difference between, I guess, the output of this forecast compared to what you might see across other kind of data outlets and folks that are doing similar type of analysis?
Yeah. So not to say that similar techniques are not used. However, there is a common trend, especially with forecasts, to essentially trend towards the average and not take into account the kind of larger macroeconomic variables at play.
I see CoStar's forecast will often just revert to like the average.
Yes. Yeah. So you'll see a bump in the trend based on which direction it's heading. So for instance, many markets are predicted to see a decline in rent growth. So generally, these forecasts will predict the decline in rent growth before it begins to gradually rise again towards the historic average. That isn't necessarily there isn't a wrong way of doing it per se, as long as the math backs it up. But we wanted to be able to incorporate some different large scale variables that we felt had a play on what would drive rent growth. For instance, we'll see in different markets later on in the presentation that job growth numbers, for instance, played a key part in pushing certain markets past what forecasts would expect to them. And a certain forecast would expect markets to absolutely just plummet in rent growth, but we see a different story, perhaps, of job growth, keeping these rent growth numbers alive, and then potentially starts as well.
Awesome. Wonderful. Awesome. Let's
just because, we're about halfway through our allotted time. Let's jump right into the report. Spencer, I'd like for you to start us off and just discussing the U.S. national multifamily market.
Yeah. Well, just jumping into the national multifamily market, if you're a subscriber of the Gray Report and if you've been paying attention, you've seen that, rents have been slowing down the latter half of 2025, which is exactly what our forecasting models were indicating. Some of that deceleration is pulled forward a little bit faster than we were even anticipating, but certainly is right on trend. A lot of negative rent growth, which is typical of this time of year. It's definitely seasonality. But there's been a lot of conversations of shifting seasonality and even a bump in Q4. Some of the recent data is showing that that's maybe not the case in 2025. But in terms of, what we're seeing, what took place this year, we added a lot of new units. 484,000 new units were delivered, but they met relatively strong demand, and relativity is key to this entire conversation because vacancy is nearing a multi-year high. Rent growth is low. I think most participants in the industry, though, are relatively surprised how well the market has fared given how much new supply has occurred. Demand has really risen to meet that new supply, but we are seeing demand come down as supply recedes as well. Deliveries, while they are coming down, as we mentioned, starts will continue. They're going to see a blip of reduction in starts for a little period of time, but they are going to get started again as our forecast is indicating. Operators have prioritized occupancy throughout 2025, and they will continue to prioritize occupancy throughout 2026 with the mantra of keeping those heads in beds. Rents have been pressured, concessions are continuing to occur throughout the market, and with just the increased amount of competition, we don't see those concessions to recede anytime in the immediate future. We're going to have to at least get closer into the latter half of 2026, maybe not until 2027 until we see really relief from those concessions. But for the forecast, 2026, kind of one of the big takes, what I want to ask John about is 1.5 million starts are projected in 2026. That's a 7% increase from 2025. And that doesn't mean those all get delivered right away. Some of those get canceled. Some of those get spread out. But so it's a lot of inventory that's going to be coming onto the market over the next couple of years. Now, that number, that's much more in line with kind of pre-pandemic levels, 2019 and prior, which I think we'd say that's a relatively healthy amount, maybe even slightly undersupplied to meet the country's housing needs, especially as more individuals are renters rather than buying homes. And that trend doesn't seem like it has any movement to reverse itself anytime soon. Vacancy, another big, story is as we're kind of peaking in vacancy in 2025. Our forecast is showing we're going to have a slight reduction in vacancy with an average of 6.8% near the end of the year. Now, that's still a higher vacancy level than the national average. Typically, kind of 95 is what most people are targeting, but a little bit of relief in terms of vacancy as those heads actually get into beds. The headline number, though, rent growth for 2026, 0.85%. It is a positive number. It's down 16 basis points from 2025. But if inflation is running at 2 to be generous, call it 2 to 3%, that's basically, a negative, call it 2% of, real rent growth. So not exactly what you want to see in an environment where expenses are coming up. That's where we're hoping for some of that relief in expenses that we talked about in the 5 takeaways. You can slash your insurance by a third. That can help out a little bit, even if you're only growing rents by 0.85%. Now, I think it's important to note while we're talking about these national numbers is that It's good when it's important from a trend perspective, but every market is so different. And even when we get into these individual markets, it's important to note that each submarket, each neighborhood can behave differently. Where you can be in a market with negative rent growth, you can be in a little pocket, a submarket with positive rent growth. Mm-hmm. Suburbia is acting a lot different than the urban core. The starts, deliveries, rent growth, again, be completely different several blocks over. So, locality is key, but understanding these broader trends is also important. So the national picture, relatively tepid, not a lot of growth, definitely a year of recovery and transition. That's for sure.
I think for everybody, just to remember that 0.85% rent growth across the national average. I just want to carry that across all of the markets that we're now going to focus on, the Midwestern markets. We can do that by starting with Chicago, if that's okay.
Let's do it.
Just that 0.85 national rent growth you're going to see across the Midwest, we're routinely leading or beating that average, in what I think is a meaningful way. Chicago specifically has been in the headlines more recently than not as a leader in multifamily fundamentals and rent growth in the United States, let alone the Midwest. As the largest, most diversified economy in the Midwest, it starts to make a lot of sense. There's a lot of demand drivers, a lot of economic development that continually is attracting people to Chicago. Now, the challenge in Chicago in 2026 is going to be a net negative migration of its residents into other states, specifically into Indiana and Wisconsin, as those are the most close in proximity to the urban core of Chicago, offering improvements in overall commute and transportation into the urban core of downtown Chicago. So in 2025, we saw quite an unbelievable amount of units absorbed in regards to the amount that's delivered, really tightening vacancy, that 4.7% this year. Looking ahead into 2026, vacancy is actually coming down to 4.2%. That really is just a story of the limited supply in Chicago and just the sustained overall level of demand. You can start to see here in 2026, you'll see starts increase, just like we talked about a bit earlier. Now in the Chicago market, that urban core is quite landlocked. There will be some starts occurring in the downtown urban core of Chicago, but it's my belief, and I think it's our belief, that the starts in Chicago are really in some of these suburban markets spilling out into the north side of Chicago and that southeastern portion of the Chicago market, potentially across the state border into that northwestern portion of Indiana called the region. In 2026, our forecast for the Chicago market includes a 2% average rent growth. And John, I'd actually just like your opinion on this graph. You can see in Q4 of 25, we do start to see this downward pressure on overall rent growth in our forecast. And then it starts to kind of normalize back on the back half of 26. What, in your opinion, is spurring that increase on that back half of 26?
Yeah. So in terms of the big dip that we're expecting to see, I want to say first off that many other forecasting sources are predicting the same sort of dip. Mm-hmm. The kind of main takeaway from it is that there was a decent level of deliveries,
right,
more than what had been observed previously, enough in the sense to push down rent growth. But as time goes on, the effect of those deliveries is going to be pulled back, and we're going to end up in a similar situation of an undersupply compared to what the demand is. So the short and sweet is we saw a good amount of deliveries. That's expected to slow down the rent growth, slow down the tightening of vacancy just a bit. Mm-hmm. But then as time goes on, once those deliveries get completely absorbed or mostly absorbed, we're going to see a tightening back on vacancy and an increase in rent growth again.
Well said. Well stated. Chicago, on the surface, in our forecast, looks like quite a favorable market to enter into. Now, there are some headwinds and some challenges that may present investing into Chicago or Illinois in general. Spencer, would you mind kind of expounding on some of those headwinds in Chicago?
Yeah, some of it's perception, some of it is reality. Cook County has always been challenged in terms of, a potential tax liability, and that can go for the whole state of Illinois, but it's never as extreme as compared to Cook County. So, there's a lot of local owners and operators that they get it, that understand it, their boots on the ground. They know they know the local politics well enough, or they're comfortable with it. It makes a lot of other, I guess, out-of-state investors they're just worried about getting into that type of environment. I mean, I've seen it just in my career of where, reassess all of Cook County has been reassessed, and it's basically frozen the property market. And so it begs oneself of just, are there other markets? Are there better markets out there? Now, the result of that type of mentality in folks like Gray Capital not investing in Chicago is that they've built so few apartments in the last couple of years. And supply is key to so many of these stories of where rent growth is. And this is a case of where, 5,000 units delivered for a market like Chicago, that's nothing.
Mm-hmm.
I mean, in New York, we'd be talking about, tens of thousands of units, 20,000, 30,000 units, or Dallas or Houston. 5,000 units. Indianapolis built 5,000 units, a year or two ago. So that's just a drop in the bucket for a city like Chicago. And so it's not shocking that absorption absolutely crushed that amount of deliveries, that it's one of the top rent growth markets in the country right now. And it's going to be one of the top rent growth markets in the country in 2026.
Right.
So again, there's challenges, but risk equals return. There's some opportunities for some folks that say, hey, I'm comfortable with the political environment. I understand the political environment. There's a great opportunity because the competition has been cleared out.
It's tough to deny that Chicago has a massive economic gravitational pull to it. If you're willing and able and equipped to jump into the market, to battle some of these headwinds, to cut through some of the red tape, you could be quite rewarded.
Yeah.
Awesome.
Yeah.
Let's jump to the next market. I think it's Indianapolis.
That it is. Indianapolis, it's the home market of Gray Capital. It's where I myself personally was born and raised, so I know it like no other market. It's why we like to buy Indianapolis as often as we can. But taking Gray Capital out of it, Indianapolis has really emerged on the investment radar for multifamily investors in the last several years as a really exciting market. Previously, it's been characterized as higher cap rates, very slow and steady growth, but a great cash flow market. If you're an investor looking for cash flow, Indy has always been on the list. But now it's transitioning to a market that not only features great cash flow, but also some potential growth and appreciation. Like other markets, it's important to understand the kind of the relative history of Indianapolis, because right now, as we're looking to 2026, especially the first half, things are going to be really slow. And Indy has been compounding consistent rent growth for years. Even go back to the great financial crisis, the rent growth was not as negative as in most other markets. In the pandemic, we maintain positive rent growth. And so again, it's on this compounding growth. But that doesn't mean that it's all going to just continue growing. Indianapolis, as I mentioned, we delivered a ton of units. Deliveries outpace absorption for 6 consecutive quarters, and vacancy is really topping out. Indianapolis has always been a relatively kind of high vacancy market, just historically. We're at 10% vacancy right now. Rent growth, while it's hit at around 2% in 2025, it's well below kind of our long-term average. And we're just dealing with the increased competition from all of these deliveries. Now, 2026 limited, we're going to see a major reduction in starts, only 5,000 units, which again, that's how many units Chicago delivered, just how few units were being delivered in Chicago. But only 5,000 units are going to be started in 2026 in Indy. Again, that's a 92% decrease, a year-over-year variance from 2025. Vacancy, again, projected to be 10.4, so a tick up in vacancy. Rent growth is going to be subdued, 1.5%. That means, again, we're missing out to inflation, negative real rent growth, positive nominal rent growth, but it's going to be a slow year in Indianapolis. That's why we're looking for those opportunities, the pockets of rent growth, much more in the suburbs than in some of the urban core. But there are all these little opportunities of where folks aren't going to be able to underwrite aggressively because they're going to see slower growth. But it's also a time where we're going to be careful because there's a lot of people that are looking in Indianapolis right now. We've made acquisitions in Indianapolis over this year in 2025. We also made an acquisition in 2024. We're always going to be looking for deals in Indianapolis. My gut is, though, we're probably not going to be competitive on any marketed deals in Indy because we're going to know where that value is, and we're going to be looking for some true basis opportunities and something where we know there's a lot of value, where someone from out of town may be missing some of that value. But Indianapolis is going to be a tough market this year. But if you're looking at Indianapolis over the next 5 or 10 years, it's going to be a great entry point if you can find that great basis play. Some of the exciting stories in Indianapolis and just why the economy is growing the way it has been, why the interest. It's a great combination of logistics. I mean, we're the crossroads of America. There are more major interstates that come through Indianapolis than any other market in the country. We're the second largest FedEx hub in the entire world, one of the top markets for air cargo in the entire world. And then our bio, life science, and pharma companies. I mean, Eli Lilly, Roche Diagnostics are have a huge presence in Indianapolis. Eli Lilly has over an $8 billion project up in Boone County, which is immediately northwest of Indianapolis. They have an additional $2 billion investment that they're working on right now. And then just the amount of battery manufacturing, EV manufacturers, whether that's up in Kokomo, it's Stellantis, or surrounding Indianapolis. It's incredible to see Indianapolis has always been a manufacturing kind of hub, like much of the Midwest, and seeing that be really turned on and elevated, more advanced manufacturing, which Indy's been doing a lot of advanced manufacturing for quite some time, whether it's Rolls-Royce and making, B-52 engines, whether it's Cummins making all types of different engines. We have all of this really awesome technology. I mean, we're the second largest Salesforce presence in terms of technology in the country outside of San Francisco. So it's really diversified between logistics, technology, biopharma, manufacturing. And it's affordable as heck. I mean, there's very few markets that are as affordable as Indianapolis. We've seen compounded rent growth, but it's still cheaper to live in Indy than it is to live in a lot of other markets in the Midwest. When folks are looking to move somewhere, again, they're looking for job opportunities. Indianapolis has a lot of those job opportunities, but then they're looking at, okay, what's the quality of life? And then how affordable is it to live there? Are there good schools? Can I buy a nice house there? Especially if you're coming from a place like California, you're looking at the real estate you could get in Indianapolis or the apartment that you could rent in Indianapolis. It's a no-brainer. That's where we're seeing a lot of movement from folks on the coast, from Chicago into Indianapolis proper. But some of the risks in Indy, obviously, I think right now as a local owner and operator is the story out. I don't think it's too late on Indy, but it's certainly you're not getting in really early.
Sure.
I've had conversations with recent investors who are surprised about that. I think you get a little bit of a higher cap rate. The cap rates right now, a lot of that growth is relatively priced in. You have to really find kind of a wedge or a pocket opportunity to really get that value. But that's also why I'm looking forward to 2026, because as Indianapolis comes down on the rent growth leaderboard, that's when I'm going to be looking at making an opportunity as folks are going to look at the next kind of shiny thing that could be an opportunity to swoop in and buy some good deals at a decent basis.
Seems like it's a strange world if you wake up in the morning and you don't see a positive economic development announcement article in Indianapolis. There's so much growth going on here, whether it's across all the sectors you mentioned, manufacturing, tech, healthcare. Doesn't matter what it is, there's always some kind of positive economic development story that's either progressing or getting announced. It's an exciting time in Indianapolis.
Yeah, it is.
Now, the next market, equally as exciting in regards to economic development and overall growth in the past 12 to 24 months, maybe even a bit longer, is John's hometown of Columbus, Ohio.
Yep, that's right. Grew up around the Columbus area and spent a lot of time researching on the different dynamics of Columbus. Really exciting place. Really just sustained growth. I mean, Columbus has been ranked number 1 in the U.S. for combined business growth and infrastructure investment in 2025 and has been ranked that since 2021. There's been $38 billion of investment in the region and nearly 28,000 new jobs created. Really, Columbus is the story of job growth fueling fundamentals. So loads of people are moving in from Silicon Valley, Columbia, moving in from financial capitals, moving in from expensive places to live looking for a place that is relatively affordable and has good job opportunities. And it seems like Columbus has been that place. One great example is the Intel plant. It's still under construction. We'll note there's been some hiccups along the way, but we've seen over $20 billion in investment in just that project alone. And as a result, many high-profile, high-skill workers have been coming in from the and have been looking to create a life here. As a result, units being started is pretty high, higher than one may expect. And we're expecting that trend to continue into the future. However, we are still expecting vacancy to be on a slow decline and rent to be at a comfortable position. With that, really the story is that even though we do believe that there is a good amount of starts planned to be underway, the job growth and the economic opportunities are driving a continued demand for that market.
It's interesting, again, just the other side of the coin. For Indianapolis, that huge reduction in starts, but Columbus, there's really a big surge of starts. Is this, every market can be in kind of a different phase, if I come on the spectrum, expansion, growth, retraction or recession. Is it just the phase, I guess, of where those markets are on their cycle? Is it that the Columbus, I feel like Columbus has gotten a lot more headlines of economic development headlines nationally than a market like Indianapolis has, primarily driven by the Intel story, the huge the chip fabrication facility that they're building out there. Any other insight of why Columbus is really scheduled to start a lot more apartments next year compared to some other markets, or just the demand being baked in?
So, like I said, a really big part is that job growth. Columbus has been kind of leading the way in terms of Midwest revitalization. With the jobs created and many of the opportunities developed during COVID era and even before that, it allowed for many people in Columbus to get kind of a jump start on these opportunities in the multifamily market. Whereas now that job growth and job creation is starting to spread across the Midwest as a whole.
Tell us a little bit about kind of downtown urban core Columbus versus some of the suburbs. A lot of shift to the suburbs, but I know there's a lot of corporate headquarters in downtown Columbus. How's the downtown faring? I don't know how much time you spend downtown or not, but
downtown is pretty lively.
Yeah.
You always see people walking across the river. Lots of offices still require in-person work or have been requiring people to come back in person. Now that we're pretty much wrapped up from COVID. However, a trend that is being seen, that we have seen in the data, is that while there is many construction activities happening in the downtown area and many multifamily activities happening, there is a lot of activity on the outer belt kind of areas of Columbus. The farther you get from Columbus, you see some very exciting rent growth opportunities in places like Licking County, where I grew up. Just 30 to 45 minutes east of Columbus. Many people are moving there to seek maybe some more affordable options while still being inside of the Columbus economic zone, so they can still drive to work. Many people in Columbus do commute every day, a decent distance, and so many people are okay with living maybe a little farther away from that urban downtown so that they can get in at a more affordable price point. This has resulted in a very high amount of starts happening in the areas surrounding Columbus, but are still part of that Columbus economic zone, and has fueled just a really, really high demand in the area.
Just to be clear, I guess, just to clarify for the audience at home, on our reports, we're looking at the whole economic zone or the MSA, not just like the city proper.
Yes.
Correct. Yeah.
2.2% average rent growth across 2026. That's a leader in our forecast. So it's an exciting time to be looking to acquire assets in Columbus, but also an exciting time if you are a multifamily owner operator to be positioned in that market.
Yeah, that's going to be probably some of the strongest rent growth. Certainly some of the strongest rent growth that we're forecasting. But if the nation follows the similar trend, it could be one of the top rent growth leaders in the country next year.
Right. Yeah. Let's dive into the next market, Cincinnati, Ohio. Would say this is a rather overlooked market in the Midwest. I think that being 2 hours, maybe a little bit less away from corporate headquarters, it's been on our acquisitions board or our target markets board for quite some time. But I learned a lot about Cincinnati through this report, specifically just what drives Cincinnati, what's happening in Cincinnati, why is Cincinnati there? Geographically, it's quite advantageously positioned just north of the Ohio River. Just a few miles to the west is what is Hamilton, Ohio. It's right on the Indiana-Ohio border. It's an affluent suburb. There's a lot of growth headed out to the west, but also south as you cross the Ohio River into the state of Kentucky, where Covington is located, another great suburb of the Cincinnati market. There's just a lot of economic development happening in this area. Specifically, Cincinnati is ranked among the top 3 U.S. metros for site selection in 2025 based on infrastructure and growth site selections. So that's an exciting thing. Looking at Cincinnati, it could become, potentially become something like Columbus, Ohio, where there was a lot of site selection going on for large, investments into corporate headquarters, acquiring land and setting up large scale economic developments. Top 3 in the nation in Cincinnati, so there's a lot of future promise there. And then also the other kind of fun fact that I wanted to hit in regards to Cincinnati, something that I learned, is it's gone 21 consecutive years as the top 10 metro for corporate facility investment. That's something that was quite surprising to me. 21 consecutive years is a long time running. So specifically in Cincinnati, I think it's largely similar to the Columbus market, where a lot of the demand and the growth is being spurred on by high income labor, skilled labor, and the relative affordability of the market. And so looking back at 2025, again, we saw vacancy hit a decade high at 7.3%. This is, again, a part of this supply wave that we saw in this past year and really in 2024 and 2025. But as we start to see the supply, come down in 2025, we're not seeing a lot of starts in the Cincinnati market, an 88% decrease year over year from 2025. But we are seeing a slight uptick, I would say an insignificant uptick in vacancy at 7.5%. But with that uptick in vacancy, we're also seeing what I think is healthy rent growth in the Cincinnati market at 2% average across 2026. I'm very excited to see this, as this has been a market that Gray Capital has been looking at for acquisitions really since I walked in the door. What excites you most, Spencer, about the Cincinnati market, about the economic development that's occurring as we look to enter the Cincinnati market in regards to our portfolio?
I think Cincinnati, it's pretty well diversified. What I like about it, it's a market, and this is just personal, but it's a market that I feel like I understand because, again, it's very close proximity to Indianapolis, right. Has very similar drivers, major logistics being, right on the river, a lot of manufacturing, a lot of just history in manufacturing in general, but also it was able to diversify when in the mid 70s, when there was a lot of hollowing out of the Midwest and, coining of like the Rust Belt terminology, over time, Cincinnati was able to diversify quite a few kind of corporate headquarters in Cincinnati that has been able to help kind of buoy it and get past some economic downturns. But it's a little bit more off the radar. It's not as talked about as much as Indianapolis or Columbus. The growth story, it may not be as well defined as at Columbus or Indianapolis, but I find, just again, because we'll be talking about Lansing in a couple minutes,
right.
You don't always need to have the strongest growth to be a really good investment market. It's where the intersection of kind of supply and demand meet. And sometimes that, again, why Indianapolis has been such a good market over the last, and many of these Midwestern markets have been so great, is just because they've been off the radar. And it's going to a market that does have growth, but is just not being focused on by a lot of institutional capital, giving you just a better entry point, higher cap rate, but then allowing that growth to occur and the cap rates to compress a little bit more over time, which you don't need the cap rates to compress. But I guess there's more room for them to compress. If you go into a market that has all the investors already looking into it, like a Columbus or Indianapolis, you're usually going to be starting at a cap rate that's going to be a little bit lower. And so there's less opportunity for that cap rate to further compress, because it's harder to compress down as it gets lower and lower, because it's not on a linear curve, it's more exponential. So again, that's where Cincinnati's exciting. You might be able to find more of those kind of one-off opportunities at a great basis and to take advantage of future growth.
Right. I want to recognize that we are at the hour time limit. If you like this kind of information, if you like this kind of data visualization, if you like this kind of analysis and input, go to graycapitalllc.com, subscribe to the newsletter, and or subscribe to this YouTube channel. We bring you a weekly newsletter as well as a weekly podcast hosted and co-hosted by Spencer and myself. We look forward to bringing you continued updates, but if you're able to stick around, please do stick around, as Spencer, John, and I are going to unpack the remaining markets and answer any questions that remain. Let's jump into the next market and just
Louisville,
keep going.
Louisville, Kentucky. Louisville has a lot of similar themes as a lot of these markets that we've talked about, but with logistics being a major component, manufacturing, and then just these new industries, new manufacturing, especially battery plants and electric vehicles. Louisville has had a lot of supply that's come on the market the last couple of years. It's vacillated between some positive rent growth, some negative rent growth, but generally it's been an interesting market. Also similar to Cincinnati, it's more than just Kentucky. If you look over on the Indiana side of the border, and in Jeffersonville, some of the other nearby markets, there's some really interesting suburbs that are very attractive. Again, some folks call this the EV production capital. There's a $5.8 billion investment from Blue Oval SKA battery park that's going to potentially create 5,000 jobs. So there's a lot of, again, just battery plants, new manufacturing that's coming into Louisville. In terms of our report, supply has outpaced demand. Again, a lot of that supply and the demand has been concentrated across the river. Deliveries are expected to slow in the back half of the year. So while we've been delivering a lot of units, they're supposed to slow down kind of the second half of 2026. But we've got a lot of starts. This is another one of those markets similar to Columbus, where we're seeing a huge surge in new multifamily starts. Right now, we're forecasting 3,389 starts are going to begin in 2026. It's 142% variance from the previous year. So it's a huge jump. Vacancy, we're forecasting an average of 8.5%, so relatively moderate and a little bit off of 2025's numbers. Some of those new units get absorbed. Rent growth, nothing to write home about, but it is positive, 0.9%. That's down from this last year by a whole percentage point. Again, this new inventory has to be absorbed. Most likely, we're going to see continued concessions throughout the year and just pressure from all of that new supply. Louisville is going to be one of those markets where, again, I think it's noisy. As I've been tracking Louisville for well over a decade. It's always been a noisy market, but then it can come off with pockets of really strong growth. It's relatively landlocked. It's difficult to build in Louisville just given the geography and the terrain, so it can be supply constrained. But as we've seen, a lot of folks are still projecting to build quite a bit more units and find spaces to do so. Louisville, you want to know where you're investing. There's good spots to invest in Louisville and some unideal spots like most markets. Again, we really like being on the Indiana side of the river, but there are some good spots in Louisville proper to take a look at as well.
It's this hyper local nature of real estate that allows us to operate in these Midwestern markets that are, only Louisville's an hour and 45-minute drive from where we sit here today, maybe less, hour and a half.
Yeah.
Gives us the kind of a prime mover's advantage in regards to really understanding and knowing these markets intimately, as well as the pockets in which maybe are more advantageous or less advantageous. So you mentioned the Southern Indiana, Jefferson, and Clark counties and the landlocked nature of Louisville. The growth has kind of jumped over the river and is really in Southern Indiana. There are also pockets within the Louisville market in Kentucky that can be quite advantageous if you obviously grab the right asset.
Yeah, 100%.
Awesome. Let's keep it moving. This will be what I believe is the last market we're going to dive into John's going to walk us through Lansing, Michigan. This is an exciting one for us, John. Open it up, I guess, talk a little bit about the data availability before we jump into the forecast for 2026.
Of course, yeah. So as we get into smaller markets, we get into some interesting and unique challenges with analyzing the data. Specifically, that markets getting as small as Lansing, while they're not small in a geographic size, they are small in a terms of how many units are being constructed per quarter, for instance. So we even see some quarters where nothing is being started. This affects the data in various ways, especially when it comes to forecasting, because it's really impossible to forecast, which quarters are going to have starts and which quarters aren't. You could go out and ask every individual, person with a permit, planning on building when they plan to build. But of course, that is, easier said than done. But looking at a market like Lansing, we have seen some very, very high rent growth in Lansing in the past year, even in the past couple of years. Generally, we expect this to decline as more supply comes online. There is some good job growth that is fueling this high rent growth as people are moving in. It's a desirable place. You have lots of young professionals coming in from Ann Arbor, from University of Michigan, from other universities to work at the different opportunities that are opening up here. For instance, there has been multiple EV and electric vehicle and battery technology plants and companies and investments being made in the area. Seeing in the term of billions of dollars of investment in the area, and this is driving a high demand to move into this area to secure these high-paying jobs. We are, however, starting to see a supply catch up to that, and with that, we do expect rent growth to peak around Q4 2025 before dipping down closer to 1% by the end of 2026, with an annual average of 1.9%. Which is 180 basis points variance from the previous year.
Just be curious, either of you guys, the kind of perspective on this, on the graph we have displayed, where starts essentially either go to zero or we're just kind of indetectable in regards to the overall supply and demand fundamentals in Lansing. In 25, they delivered less than 300 units, but had abnormally or historically low absorption. In 2026, we're forecasting just over 300 units at 361 units. In a smaller market like Lansing, what does 361 units do to rent growth in regards to maybe following up a year that had historically low absorption? I guess what can we expect in regards to 361 units hitting the market that otherwise hadn't seen that many deliveries in potentially a few years, since Q1 of maybe since 2023.
Yeah. So I will note that with this forecast, of course, it is going to predict, somewhere in the middle between a certain amount of starts and zero starts.
Right.
Because it can't predict when we're going to have zero starts. Likely some quarters there will be zero starts. But with this forecast, we do believe and suggest that as more supply comes online, this just the high level of rent growth is not going to be sustainable. And not even in regards to the market, but, in regards to the average, consumer, for instance.
And partially that's because there's been so little supply that has been able to achieve high rent growth, just because there's been no real new inventory with some positive job growth. And so just a little bit of new supply, can potentially suppress, some of that rent growth. So, potentially a little bit more volatile market, because it could be more sensitive to some of those swings. But just historically just hasn't been one where you're seeing, that much inventory growth, which has just made it, again, I guess, a little bit of a pocket market. We have a property in suburban Lansing, just outside in Okemos, Michigan, and there's really been no new supply since we acquired that property several years ago, and really none that we see that's on the market. But there's good job growth. The rent growth has been very favorable, so it makes sense that there would be some new deliveries at some point. And so it's really kind of catching up And that's what we often see in these Midwestern markets is they can kind of get away with some strong rent growth with not a ton of economic drivers, but just enough to continue to grow. And then developers are catching up a little bit.
Right. The foundation in Lansing is there. We were talking last week just about it. It's the state capital. It holds the state seat. It's got a major university. The hospital system is there.
Yep.
There is 100% reason for smart, talented individuals to want to not only move to Lansing to work there, but again, to start families. And so the demand is there already on a foundational level. If there is any kind of economic development in the future, you can only see these forecasts or the rent growth numbers continue to look better and better.
Yeah, no, that's a good point. Kind of the meds and eds and just some of the state government acts as a ballast to the market. There's always going to be jobs that are recession resilient. The economic downturn, well,
correct.
You're still going to have jobs at the university, folks living at the university.
Yeah.
The state government is going to continue to function. And then anything else on top, other industries are just a plus. Again, like you mentioned, there's a lot of auto manufacturing, more EVs that are going to be built in Lansing. Now, maybe not as many. I guess the volume of like economic development stories is less than probably of any other market that we've covered, but also probably has the least amount of multifamily investor interest,
right,
compared to any of these other markets. Just the Michigan multifamily markets in general don't have as good of coverage. There's certainly more this year than there was even just a few years ago. But Michigan, from our observation, is a market that has historically been underserved from, again, just multifamily brokers. That's changed a little bit. There are more folks that are paying attention. But even in that case, it often can be like an ancillary, like I'm covering a market, but I'm also covering Michigan.
Yeah.
There's only a few folks that that's all they do is cover Michigan.
And an attempt to kind of summarize and not wrap up what we're doing here, but I want to kind of tie it all back together. We sent out an email that essentially compared and contrasted or kind of put up to competition Chicago versus Lansing. Chicago has 2% average rent growth across 2026. Lansing not far behind with, I think it's 1.9 is what we just posted. If you're an investor looking to allocate funds in the multifamily asset class, I guess maybe give me an argument or provide an argument why you might choose Chicago over Lansing or Lansing over Chicago.
Well, that's interesting comparisons because both Illinois and Michigan are less landlord friendly than some of the other states that we're looking at in the Midwest. So they kind of both have that negative to go against them. Now we're talking about Chicago, Cook County versus Lansing, and even some of the even Lansing proper. You probably have slightly less, I guess, tax volatility or tax risk, maybe slightly less regulatory risk from Chicago going to install some sort of rent control regime. You technically still have that risk in Michigan. There'd be a higher risk of rent control regime compared to a state like Indiana, Ohio, or Kentucky. But I'd say Illinois has the highest risk compared to all of the states that are at least in this report. Chicago, it's like everybody knows Chicago, but is everyone looking to invest into multifamily in Chicago? I'd say you really need to know what you're doing in that Chicago market, like have some boots on the ground, and truly be an expert to be able to navigate that. Lansing, again, the more boots on the ground is always good, but I don't think that it's as important in Lansing. You need to know where to invest clearly. That's always the case, but it's less competitive. It's going to be a little less cutthroat than a market like Chicago. So some of it's almost a style preference, and what type of market do you really want to get involved?
I appreciate that perspective. Yeah.
Well,
awesome. I saw you pulled up the Midwest comp set. I think we should take a look at this and just discuss it kind of in generalities. But you can see all of our markets here, placed on this plot with cap rates on your vertical axis and rent growth on the horizontal axis. Anything stand out to either of you guys?
Well, all the markets are, again, this is a snapshot in time. And so, these markets all move around. If we looked over the last year, a couple of years, and as we go into the future, they're going to move around as well. I think, as the story has been consistent for quite some time, the Midwest is just outperforming the nation. All these markets, it would make sense that some of the markets would be really underperforming the nation. But, all of our Midwestern markets, and I guess, technically, Louisville slightly below on rent growth, but even basically just on par with the national projection. And, cap rates, I mean, that's a perception. Cap rate, higher cash flow, maybe less demand priced in. I think it's worth noting that these cap rates, I think they're relatively correct. The lowest cap rate on this chart is a 6 cap. There are very few stabilized deals trading for even a 6 cap. Certainly there are some trading for above a 6 cap. Right now in the market, I'm seeing most core plus deals, call it, A to A minus class assets, trading in the kind of the 5 to 6 range, where more value add deals are trading in the 6 to 7% range. And in our market, we're seeing more kind of core plus trade and less value add. I've known there's some deals in Indianapolis that have traded below a 5% cap rate. So again, all is relative. But so I think generally Lansing, we have a 7.5% cap rate. I'm sure there are some older value add deals that would trade in Lansing for a 7.5% cap rate, but your Class A, core plus community is not going to be trading for a 7.5% cap rate. If it was, I would be calling all of our investor partners, and we'd be going.
We'd just be fundraising.
We'd be shopping in Lansing, because that'd be great cash flow for a market with some good growth. Not the strongest growth, but good growth. This chart also rent growth and vacancy. Again, I think Indianapolis, frankly, on both of these charts looks like just not the market that I would be as excited about. As we just said, though, again, this is a snapshot in time. Right now, Chicago looks like the most attractive market. Maybe that narrative changes. That narrative can change if there's a negative, tax story, but. To me, Chicago looks really attractive. Columbus looks really attractive. Again, Columbus, relatively, if this cap rate relativity is halfway true, that would be an exciting entry point with some good, some good rent growth, that would follow. The reality is, there's not that many deals on the market in any of these markets, and so again. If I could find something in Columbus, we would love to go and acquire it. It's just it's a challenge to do. Even in Cincinnati, even in Lansing. I don't know. You guys have any thoughts?
I just keep looking at Cincinnati. I don't know why I'm so excited about Cincinnati. For some reason, I really like it. It's very similar to the Indianapolis market in regards to the style of living, affordability, walkability, the surrounding suburbs. It doesn't stand out as the clear front runner in our 2026 forecast, but it does seem like it could be quite an interesting market to really focus on if I had to pick one in the upcoming year.
Yeah.
Based on all the fundamentals, really, there is very strong opportunity for Cincinnati to kind of be the next Columbus story. The job growth is there. The starts have not caught up. What that suggests is potentially, a couple of years down the line, once these jobs start coming online, which is really kind of what we're waiting for. Once these jobs come online and the starts aren't going to be there to supply it, Cincinnati, by and large part, is seeing that supply slowdown that the rest of the nation is seeing. We're going to see a lot of people moving in with not enough supply. You're going to see some very strong rent growth numbers all across Cincinnati.
Yeah. I think it's a good point. There's interesting. We got some good consensus. Question coming that just came in, very pointed, and it's good to bring this up. We didn't cover every Midwestern market. There's markets such as Minneapolis that are on this list. St. Louis, Detroit would be a major market. Cleveland, and then someone in the Lawrence Fawn on YouTube mentioned Milwaukee. Obviously, we couldn't do every market for this report. I think we're looking at adding markets to our list. John, Griffin, you guys do any research into Milwaukee recently? Any thoughts on Milwaukee? And it's putting you on the hot seat, so you didn't exactly prepare to talk about Milwaukee, but any thoughts on the market?
I didn't do any specific research. I don't want to throw any data points out there, but anecdotally, boots on the ground. I've been to Milwaukee. Again, very similar to Indianapolis, very similar to Cincinnati. It's advantageously positioned just north of Chicago. It's about maybe an hour and a half drive. I've taken the train from Milwaukee to Chicago. Ease of access into that Chicago urban core makes a lot of sense, but also the suburban markets of Milwaukee, really getting out into the Aquanum. Been out there before to play some golf. Can't figure out how to pronounce it. They got funky town names in Wisconsin. Love Wisconsin, but the town names are funky. Aquanamac. There's great suburban markets out there where there's a lot of families starting, young kids being raised. I think that the barriers to entry in regards to home ownership are similar across the nation that they would be in the Milwaukee market. And so I do think there's a lot of households that are looking to be renters for the foreseeable future, potentially renters by choice, just based off of the access to downtown Milwaukee that you can get from its kind of surrounding suburbs.
John, you have any comments on Milwaukee?
Yeah, so we didn't do any sort of specific number analysis on Milwaukee.
Right.
When we went out to do this set of forecasts, we really just tried to look to get a diverse set as possible without overextending the scope, because we wanted to release this data in a timely manner.
Yeah.
In doing this forecast, we did create some proprietary methods in terms of the data analysis in the multifamily market specifically. And as a result, a lot of time was spent purely on methodology validation, opposed to expanding the forecast to be as broad as possible across the Midwest. All I can say is that in the future, we do hope to expand our scope to further across the Midwest into as many different markets as we can conceivably perform analysis on.
Right. I think we should just mention to Lawrence as well, if you're interested in discovering more information about Milwaukee, having that dialogue with our team, John or myself. My email is at the bottom right-hand corner of the report. Download it, digest it, and shoot me over an email. Be happy to discuss the multifamily market in Milwaukee with you in detail.
Yeah, and we could look to add it to the next report.
Correct.
Yeah,
absolutely.
Got another question coming in. As the multifamily sector moves beyond the 2022-2025 tumult, what are one or two key lessons that LPs can take away from this period when evaluating deals for investment in 2026 and beyond? Okay, getting out of the 2020 to 2025, just sludge, the muddy middle. So what are some lessons that we can take away as we kind of get out of it and look forward? Griffin, you have any thoughts?
Just in regards to having conversations with investors on our end here at Great Capital, we've seen a lot of folks that have had, I would say, an overwhelmingly negative experience participating in passive syndications, passive investments, specifically in commercial real estate, but also multifamily. And I think that just tempering your expectations, utilizing our report and other managers' reports as somewhat of a guardrails to your expectations. We are projecting growth, but it's decelerated growth, relative to past performance. Patient capital is always the best capital. I think that if you're looking to generate outsized returns in short periods of time, commercial real estate, specifically multifamily real estate, maybe is not the asset class to do that. I would say if I'm trying to position an investor and their expectations, I would say be prudent in seeking overall cash flow investments, because I think that's really where the multifamily asset class shines in regards to overall, forced appreciation on the back end. That will come, if you're investing in the right markets, potentially at the right time. But just stay focused on relative cash flow, the healthiness, financial health of that asset, in regards to trying to, not essentially get rich quick, but instead of trying to receive that large equity multiple in a shorter period of time, have more of a longer time horizon.
I think the longer time horizon is key in this market. Patience. Yeah. I mean, there's not a lot of clarity on anything. We're not real estate. I mean, there's very little clarity on what the world is going to look like in any sector. Not even to get into talking about AI, but there's a good chance that the world we're living in today is going to look a lot different than it will in the next couple of years. So a lot of it is just getting back to the basics. Having a long-term hold period, that's part of that. Not going for the quick turnaround, get rich quick, but giving yourself some time to season an asset, hold on to it, cash flow it. You should be looking at returning to deals that are cash flowing. It's hard to do because as interest rates are high and cap rates are still suppressed, the cash flow is skinnier than it has ever been. But I think that's more important now to focus on that. You don't necessarily have to be getting 8% cash on cash, but make sure you're actually getting true cash on cash and it's not all based on pro forma and projections. Right. Because if you need 5%, 10% rent growth in year one to, achieve, just, 3-4% cash on cash return, you're opening yourself up to a lot of risk that really is unnecessary. So what we try to look at now, which was very difficult over this last period, was buying on real actuals. Like what instead of, the way that assets had been priced in the last couple of years was, maybe it's your T3 income or T1 income on, T6 expense or T12 expense, all different ways to manipulate the NOI figure to present a cap rate that is palatable.
Yeah.
For a broker to say you're buying this at a 5.5% cap rate, but when in reality, on a T12 basis, trailing 12 financials, it's actually a 4 cap rate or a 3 cap rate. So being real, buying for today's cash flow, minimize the speculation. Not that you can't build a creative business plan to drive revenue, but do not just allow just the market to be the one that's going to do all of your work for you. Again, I'm all about forcing some appreciation, but you got to be really confident on understanding the market and what you can do to achieve those rent premiums if that's part of your strategy. So buy for cash flow, get back to the basics, don't overpay, but also don't be tied down through analysis paralysis by analysis. You're not going to get complete clarity. It's never going to be clear. There's never been a single investment that we've ever made here at Great Capital where it was just so obvious that we have to do this. I mean, we felt confident on a lot of our on all of our projects, but there's still a lot of uncertainty. Can you achieve this? Can we reduce expenses? Can we drive rents? At some point, you have to just make the call, is this the right sector to be involved in? Again, we don't have a lot of clarity over the next few years. We're forecasting into the next year. I remember asking John when we started this, how accurate can we be out in the 2027, 2028? I think in any environment, I think it would be questionable. But especially, we've gone through a period of where the data has been so volatile. Whether it's inflation, whether it's jobs, whether it's rents, whether it's inflation, whether it's we're not even getting the data itself as we just experienced in the government shutdown. So the future is very noisy. And so I think zooming out a little bit, think of, where is this large demand going to be coming from over the next 5 to 10 years? That's why we like housing in general, is because people are always going to need a place to live. There's inelastic demand. Again, you're always going to need a shelter over your head to some degree. And there's fewer and fewer people that can afford to buy a home, and increasing the amount of renters.
Yeah.
Will, if you mind switching over to the chart on the graph, that's just looking at home price and rent to income ratios and the monthly mortgage payment compared to your median rent prices. And we've talked about this a lot on the Gray Report, which you can subscribe to on the YouTube channel. Either the home prices have to come down significantly, combined with interest rates, coming down significantly, or rents have to increase dramatically to get back into kind of a normal spread.
Yeah.
Well, I think could single family home prices come down at some point? Maybe once all the baby boomers leave the world or they leave their houses at some point. But until that happens, I think that's going to be a slow burn. I wouldn't count on it right away. I'm not counting on a reversion to the mean or rent growth shooting up, but what I am saying is that there is ample room to see some rent growth over the next 5 or 10 years, as we just have a lot more people that are going to be renting apartments than there have been over the last several decades. Less people owning homes, more people renting, whether it's an apartment, whether it's a home. So structurally, there's going to be a lot of demand, and taking my investor cap off, as an American, I want us to build as much housing as possible. I want to bring down the cost of housing by building as many apartments and single family homes. We're not necessarily doing that. We were getting back to the levels that were insufficient a couple of years ago. We are adding supply, but there's also a lot of pushback from a lot of local municipalities in these suburbs and elsewhere saying, hey, maybe we built too many apartments. Yeah. Build it, but don't build it, across from where I live. And so structurally, over the next 5 to 10 years, I'm very excited about the multifamily industry. I'm not putting a pin on, when interest rates are going to come down. I do believe structurally we're going to be in a somewhat lower interest rate environment eventually, because technology and artificial intelligence is going to increase productivity and is going to have a major deflationary effect on the economy. I think we have short-term recency bias to higher degrees of inflation that were caused by supply squeezes, tariffs, and COVID-19. We are all forgetting the last decade where we saw, again, just a record, not just quantitative easing, money printing that didn't lead to inflation because technology had such a strong deflationary impact. And we haven't seen anything like artificial intelligence could impact society positively or negatively. But as societies in the monetary world get more efficient, we'd see ourselves in a moderately lower rate environment, which leads to lower cap rates. Combination of moderate rent growth over time and cap rates slowly compressing down is a really exciting long-term prospect. What I've learned, though, is I'm not really good at timing things. I can't predict exactly when something is going to happen. So is it going to be in 2026? I'd say probably not. In fact, if you're looking at a report, listening to what we're saying, we're not calling for really much growth in 2026. If the growth occurs, maybe it's in the latter half of the year, but it's really 2027 before we kind of turn the corner and start seeing some potential growth. But even as it stands today, and John, correct me if I'm wrong, we don't necessarily have the data to say that, like, oh yes, there absolutely will be that rent growth. So we're going to have to allow for more data to be printed, to analyze it. We'll keep everybody updated. But it's what you said, Griffin. You have to have a long-term approach.
Right.
When you're looking at investing right now.
I've got a question via email from Brett M. He is, I'm just going to kind of summarize his question, but also try to read as brief as I can. There's multiple parts. In several markets, there's a recent surge in new construction and deliveries that are concentrated in A-class properties, which has compressed rents and narrowed the gap between Class A and Class B pricing, prompting renters to trade up.
Yep.
Are we seeing this dynamic in Indianapolis? And is there a noticeable difference in vacancy trends between the Class A and Class B properties? So we didn't get that granular in our report, breaking it down by property class. I would just be curious. We've seen concessions across all the new deliveries, really on the north side of Indianapolis. It's just beginning to get widespread. As Brett M. is mentioning, there is this kind of impact on Class B and potentially Class C properties. How is that impacting? Maybe we can speak anecdotally and talk our book a little bit. How is that impacting our overall portfolio, and then also just acquisitions moving forward?
Yeah, it is happening in Indianapolis. It's interesting. We're seeing it happen across the country, and it goes really as a piece of evidence of increasing supply, regardless of whether it's luxury A-class supply, can impact rents down the spectrum, and impact as in reduce rents over time. The thought is, especially in a lower supply environment, that you build something new, the rents are high, it's going to increase all of the rents, which there can be that effect, because if you're a B-class apartment and you're charging $1,000, A-class comes in, they're charging $2,000. Well, maybe you can charge $1,500 and still get away with it. But what's happening is, the B-class apartment, they're already at $1,500. The $2,000 per month A-class apartment comes in, they can't lease it up. So they have a concession, and they bring their rents down with their concession down to $1,600. All of a sudden, some of those B-class renters are saying, man, that is brand new. It's got all these amenities. And maybe I've just had, a salary increase. I'm making more money than I was last year because wages have been ticking up. Maybe I can afford that. Maybe I can push it to afford it. So we are seeing folks trade up into those Class A properties because they can then afford it with the concession. The big question is, as those concessions are burned off, well, one, how quickly can they be burned off? Because as you can see, the setup in A-class community, all of a sudden you've leased up that property. So you're leasing it up as quickly as possible because you're trying to get off that construction loan, paying that high interest, putting a stabilized loan in place. You can only do that if you're 90% occupied. So you want to get the 90% as quickly as possible. You're leased up, you're on that permanent loan. Well, all of a sudden renewals are coming up. If you gave everyone a concession for $1,600, you were shooting rents at $2,000, but no one can afford the $2,000 rent. So you either have to release those units at the full rate, or you're going to have a huge drop in occupancy, or you continue the concession cycle and you give all those renewals concessions and slowly trying to earn your way back up on new leases, which can be a slow burn. So absolutely, we're seeing it, I think, less in Indy than you're seeing it in some markets with an extreme amount of new supply, like in Austin or Denver, Houston, Atlanta, where they're just giving some of these units away. In Indianapolis, the discounts have been more moderate. They've definitely come off of some of like the high rent that they thought that they were going to get. Because again, they created these development pro formas maybe in 2021, 2022, when there was 15% rent growth. And well, that hasn't occurred the last couple of years, and we shouldn't have underwritten those growth metrics. But the reality is they're facing the real situation on the ground is that the rents are where the rents are. They've got to get it to 90% just to be able to get off that bridge loan.
And then just as you mentioned, buying off of actual, real actual financials rather than, future earnings or future revenue. Some of this suppressed rent, achieved rent at these properties, effective rent at the properties due to concessions, hopefully creates more favorable entry points for, Gray Capital to come and buy from the developer on the back end, as not only are their backs up against the clock, but their backs are also up against solving for occupancy to then offload the property. So I think that's a relatively good point to just summarize and wrap up, unless anybody else has any major takeaways.
I think that the big takeaway is continue to pay attention to new data as it comes. We're in a very dynamic market. It's changing. There were shifts even this year. Rent growth decelerated at a faster pace than we were even anticipating. The seasonality has been shifting a little bit. And so the multifamily market today isn't the multifamily market of 2019. And there's not a lot of great analogs to go back to. Operations have changed. A lot of things, financing has changed. And so you need to just arm yourself with all like the latest information and the best information as well. That's what we try to do on the Gray Report every single week. That's why we started doing the Gray Report, starting with the newsletter, then doing the weekly podcast and YouTube show, is because we need to do it for our business, because it's what we do day in and day out, is understand, be masters of the multifamily market. So while we're doing this work, we should disseminate this for our partners and folks in the industry, because at the time that information wasn't disseminated that well. There's folks that do a good job of disseminating right now. We still try to provide some really good commentary. So if you're not subscribed to the Gray Capital newsletter, hop over to graycapitalllc.com and do that. And you can subscribe to the YouTube channel, or, Gray Report is also on Spotify, Apple Podcasts, wherever you get your podcast. We'd love to have you be a part of the show. And shoot Griffin or myself an email at any point in time. Drop any questions below this video. If you have them, you can shoot them over to us. Griffin, thank you for hosting this presentation of the 2026 Midwest Multifamily Forecast. John, thanks for being here. Drove from Columbus early this morning to be here in Indianapolis with us. Appreciate you doing that, all of your work you did on this report. Really just fascinating information. It's just another tool that we have at Gray Capital. I'm not only using this report, subsequent reports, and some of the other work that we're doing, analyzing markets, submarkets. We're getting really granular to take a very much a data-driven approach, not just an anecdote and see which way the wind's blowing, which we'll do a little bit of that too. But thanks for being here.
Yeah, thanks for having me on. It's always a pleasure. It's been fascinating getting to dive into the data. And if anybody has any questions in regards to the methodology, feel free to shoot either Spencer or Griffin an email, and they will get you in touch with me to talk some numbers.
Awesome. Excellent. Comment, like, subscribe, and schedule a meeting. If you have any questions, I'd be happy to discuss this report with you or any future data interests you might have. All right. With that, let's wrap it up. Thanks for being here. Thanks for following along.
Thanks, everyone. Have a great day.